Building a portfolio. Now, that's what I do every day. I tell people probably 98% of my time is building portfolios. If not, I'm in front of a camera talking to you. So, other than talking to you, as we do every 2 weeks, and appearing on BNN and CP24, and I'll actually be on CP24 in a few hours talking about the Bank of Canada rate decision. But other than that, I spend most of my time, or all the rest of my time, building portfolios. And really, portfolios, in my opinion, is up to one thing. That's you, the investor. You want to understand and know the investor. We call it know your client. We want to know their time horizon. We want to know what risks they're willing to take. We want to know what they want their money to do for them, their investment objectives. And then once you know the investment objectives, you then can move to putting a plan together that will get them the rate of return that they want to get to meet those investment objectives. So if you only need to, I guess, have a rate of return of 3%, then you could probably get that today owning low risk bonds, money market funds, GICs, things of that nature. But if you know that over time you need some growth, you need to start making returns of greater, let's say, than 5%, then you're going to need to have some part of your portfolio growing in the markets, either through mutual funds, ETFs, or individual stocks. So building a portfolio is all about understanding the investor and then building a portfolio to match what the investor is looking for. And when you build a portfolio, you obviously put in a lot of diversification, a lot of hedges. I can tell you today that portfolio you build over the last few years is quite different than the portfolio you would have built maybe 20 years ago. The word technology 20 years ago was something that people thought of as high risk. And I say today, technology represents not only potential for growth, but potential to play defense as well, to protect your portfolio. I have a couple of charts that actually show this. And first one here is Invesco QQQ, which is the technology chart. And you can see here how well this has done. And more importantly, in 2020, if you go back all the way to the left-hand side, you saw a dip there in technology as a sector. Invesco QQQ shows us that. But then a quick rebound about midway through the year. So we had a short dip and then a very quick rebound. So that tells me that tech fared a lot better than many other asset classes and many other sectors of the market. So when we look at tech, let's look at Apple. And let's look at how Apple did at that time as well. Now, Apple, if you go back to 2020, had a very similar dip. But again, the dip was very minimal. And Apple really took off from there and never really looked back, heading into 2021 on a high note. So what is my point? I guess is that when you look at times in the market that are difficult, that are volatile, technology over the last bunch of years has definitely come to the forefront as something to invest in that will not only help you grow, but when times are difficult, protect you. We know that the more conservative names or investments in the world are usually your largest names in the world. So what are your largest companies in the world? Apple, Microsoft, Meta, Google, Amazon. These are all your tech names. And they are also names that have grown the most, but they're also names that have been the most resilient, the names that have been able to bounce back when times were tough. So when building a portfolio, if you want to play defense and offense, I think you got to look to tech, as I said earlier in the show. I think you want to look at the Mag 7, have a piece of technology in your portfolio. Makes up almost 40% of the S&P, and it should be in a growth portfolio, most definitely. Another sector of the market, and this is a powerful, powerful chart that I wanted to show. Again, another favorite of mine. It's a chart on bank stocks, Canadian bank stocks over the last, let's call it 30 years or so. We always say bank stocks go from the bottom left to the top right. Well, let's take a look at this picture here because it tells us exactly that. There are points in time where bank stocks have pulled back, obviously in 2022, obviously at certain points before that. But I think another pullback, yes, in 2008-9 was another big pullback, just looking at my chart here. But we know that when you invest in Canadian banks, these are banks that have never cut their dividends. They've always gone, as I said, from the bottom left to the top right in charts. They've always shown growth. And in my opinion, it's the one sector that I can sleep at night and that many investors can sleep at night knowing they own as part of the core component of a growth and growth in income portfolio. So when building a portfolio, you want to look for things that you can grow with, look for things that you can play defense with if times get tough. You want to add certain investments that pay good dividends. You want to add things that maybe are on the low risk side, pay good interest. And now we know you can get a money market today fund paying almost 5%. You can get short-term bonds paying 5%. There's a lot of choice out there. And that's what portfolio construction is. Diversification, understanding your investor, understanding their needs, their wants, and building the best diversified portfolio out of offensive investments, but also defensive investments that you can.